In this video, we're going to talk about the harsh reality of what happens when the various COVID foreclosure moratoriums end. So stay tuned, bankruptcy bailout buddies. Welcome, debtors and borrowers, to Bankruptcy Bailout, because debt ruins lives, not bankruptcy. My name is Matt Burkus, Colorado bankruptcy and debt relief attorney, and today we're going to talk about a very controversial and a subject that is sort of laden with fear is what happens and what are your options when the various COVID foreclosure moratoriums end. So a lot of people have had their mortgage payments deferred for, say, 6 months, 9 months, right? So you haven't been paying your mortgage. And at some point, that's going to come to an end. And the question is, what's going to happen when that does, and what are your options? And I fear that we're facing another potential housing crisis like we did in 2008, 2009, and 2010, because there are millions of people out there who haven't been paying their mortgage. So, if you have a $2,000 mortgage payment and it's been deferred for 6 months, at some point, the bank's going to call you, and really you're only going to have 3 options, because now you suddenly have a bill requesting a payment for $12,000, right? $2,000 times 6 months of not making payments, plus whatever fees and escrow and so forth on top of that. So what are you going to do when that happens? Well, either A, you have the money and you can pay it. B, the bank may or may not work with you on some sort of loan modification or modified payment. But as history has taught us, those tend not to work. Because if you could pay your mortgage, you should have kept paying your mortgage. And it's not like you're going to suddenly go from a $2,000 mortgage and then be able to pay a $3,000 mortgage to get caught up over the next year, right? Or over the next year. So that leaves Chapter 13 bankruptcy at that point. So Chapter 13 bankruptcy allows you to force your creditor or the mortgage company into a payment plan, and that payment plan can be as long as 60 months to make up for the arrears. And then, of course, because it's bankruptcy, it'll address whatever other debt you've accumulated, whether it's credit card debt, back taxes, payday loans, personal loans, whatever else you have, are unemployment benefits that you have to pay back. Yeah, all that's going to be wrapped into the Chapter 13 bankruptcy. So the good news out of this video is you do have options. There is a sort of Plan B option, and that Plan B is going to be Chapter 13 bankruptcy for a lot of people when that bill for $12,000 or $10,000 or $18,000 comes from their mortgage company and you can't pay it, and you don't have the resources that will allow you to catch up those payments, and the bank's not willing to modify your loan. But again, the options are going to be either A, you can pay the mortgage, B, the bank may or may not offer a loan modification, but you'll have to talk to their loss mitigation department when that time comes and see if you can work something out that you can actually do. Or lastly, you will turn to Chapter 13 bankruptcy, which is probably going to be the most cost-effective option, because that allows you to take the mortgage arrears and spread it out up to 60 months to catch up the mortgage. So hopefully you don't find yourself in this situation, but if you do, my name is Matt Burkus, Colorado bankruptcy and debt relief attorney. I handle mostly Chapter 13 bankruptcies in the world of bankruptcies, basically. I offer free initial phone consultations to residents of Colorado for the purposes of bankruptcy. I also handle back tax issues and student loans. Best of luck to you.